Thank you very much, and good afternoon, everyone. It's my pleasure to introduce the panelists for this session. We have a very interesting panel in this respect that some are working for direct hedge funds, others for a mixture or for fund of hedge funds more precisely. So we will have the opportunity to discuss a variety of different subjects related to what type of strategies are the winning strategies for the future, and especially for the coming month, the coming year. So we have on the panel from left to right Fabrice Cruchet from Dexia Asset Management, based in Paris. We have Martin Kalish from Waterstone Capital Management, Stephen Oxley from PAMCO, and Peter Warren from CQS. What I would like to ask them is just to introduce their firm very, very briefly to have a clear view on what they are working on.
Okay, thanks, Michel. So my name is Fabrice Couchet. I'm running the alternative business within Dexia Asset Management. So as you said, from Paris. Dexia Asset Management is a leading player in alternative asset management in Europe with around $6 billion of assets under management. And we are managing these $6 billion under various different strategies, single and fund of hedge funds.
Hi, I'm Martin Kalish, Chief Operating Officer of Waterstone Capital Management, located in Minnesota. We're a $1.7 billion credit firm that specializes in convertibles and distressed securities. Currently, we have two products where we have a market-neutral product and going to be launching a liquid distressed fund as well.
My name is Stephen Oxley. I'm a Managing Director and Partner at PAMCO. We're a fund of hedge funds firm, mainly institutional in terms of our clients. We manage about $8.2 billion. I'm based in the London office, but the firm was founded in California, which is where we have our headquarters.
And my name's Peter Warren. I'm a portfolio manager at CQS. We are a credit-focused alternatives business. We have around $11 billion invested in a range of primarily credit securities across investment grade and high yield, ABS and convertibles. We're based in London.
Thank you very much. Just as a matter of introduction, it's obvious for everyone here in the room that we had a quite bumpy market circumstances and economic situation last year, and probably the volatility we had last year will remain for a while, with a lot of problems still being part of this world, with thinking of the Eurozone, for instance, the indebtedness of a lot of developed market countries, with also the growth coming from emerging markets, but some countries showing less growth than they showed in the past. So a lot of uncertainties are still around. That's the context we are working in this year. In terms of hedge funds, when we are advising clients for the structure of their investments, we are looking very much at different return drivers which have an impact on their investments. And one of the drivers you can have for return and risk in your portfolio is skill. Where do you find skill? Well, in everything which is actively managed, you could say. So active management as a whole, but truly also in some asset classes, more in particular, private equity being one of those, but surely one of the purest asset classes, if you can call it an asset class, is hedge funds, where a lot of skill is around, and you can capture that skill premium by investing in hedge funds. That's a very important element in how to look at investments. And in recent past, of course, hedge funds have been, in some years, thinking of 2008, really disappointing in terms of performance and also volatility. So it has not always been easy. Last year as well was kind of difficult year for hedge funds as a whole, although there were a lot of differences between different strategies and different managers, of course, and even very successful managers of the past were really struggling to add value. So in this context, I would like to ask the members of the panel their view on a couple of questions, starting with the following one, which is your general opinion about where hedge funds stands right now. What do you feel about hedge funds as a whole, and where do you think we are going to? Fabrice, if you can start.
Okay, so as you said, environment and visibility is very low, and it's not an easy task to pick up good picks for 2012. So hedge fund as a whole, I say, will be in that context where clearly risky asset classes are very volatile, and historically non-risky asset classes such as bonds are not safest anymore and are not yielding anymore. So in that context, are hedge funds the new safe haven assets to be held? I think that's maybe a bit provocative, but I believe that hedge funds are able to answer many of investor needs today, which are to diversify for traditional asset classes and which are to mitigate risk within global portfolios. So I think for the picks of 2012, some strategies or some skills, specific skills, can be picked up to try to answer these questions. So really there are all the room within portfolios, and much more than ever.
Yeah, I mean, there's a reason why to own hedge funds in a portfolio. The most important thing is just to understand what their mandates are, and as long as you understand them and understand what they invest in and how, more specifically, how they could lose money, there's definitely a risk to be taken there. So it's extremely important to understand the risks. But there's definitely reasons why to still have hedge funds in in your portfolio.
Looking at it from the point of view of the business of hedge funds, I think that clearly hedge funds are now back at peak assets. They've started to grow again. We've got $2 trillion allocated to so-called hedge funds around the world. I think the industry is bifurcating. We've had some clues a bit in some of the pie charts that we saw in earlier presentations about smaller managers and larger managers. The direct institutional flows are definitely making the larger managers grow larger more quickly. And there is this huge number of smaller managers, which is the area that we're interested in. I think that institutions will want to continue to allocate to alternatives, that in many cases, if they're allocating directly, they'll go towards those larger managers, which produces an opportunity in the smaller manager niche strategy area. And I also think that you're going to see so-called traditional asset managers get into the hedge fund space if they're not already in it, offering low-cost alternative beta or even low-cost sort of multi-manager hedge fund type offerings, which will appeal to their institutional client base. So I think the industry has changed out of all recognition since 20 years ago when I first started looking at it, but it's all interesting and still go, go, go.
I don't disagree with anything any of the other panelists said. If I'd pick up on one thing, it'd be the following. There's been quite a lot of media coverage, general talk about hedge funds having had a, in inverted commas, disappointing 2011. And yet, to the previous comment, inflows remain quite strong, and certainly we're finding that to be the case. And I think the thing that may square that circle is the fact that the majority of hedge funds are now delivering something approximating to what they're promising to investors. And I think the last time we had a real market shakeout in 2008, a lot of investors were extremely disappointed with the outcome in terms of hedge fund investments, because there was a huge mismatch between what they felt they had been promised and what hedge funds delivered. My sense is that in the second half of 2011, although certain strategies in certain areas were clearly disappointing, that in general there was a closer match between what most big institutional hedge funds had offered and what investors got. And I think that may square the circle. Put another.
I warned you about that.
Is that any better? Maybe I'll try being a little bit further back. I have a loud voice, so I think I'm just going to talk loudly and move that a long way back. I would say, put another way, I think you look at the scenario analysis for most hedge funds, and what the scenario suggested and what actually happened were reasonably matched. And I think as a result, investors were less disappointed the second half of last year than perhaps they were in 2008. But for whatever reason, to answer the question, I think the hedge fund industry is in good shape, especially the bigger, more institutional players.
Thank you very much for this general view on where we are on hedge funds. More in particular, I think that you, as members of this panel, have very clear views on what type of strategies would be interesting for the coming future, and what could be the real winners of in the hedge fund world in the coming 12 months or 2 years. And this is probably quite different in terms of answer for the ones of you managing fund of hedge funds and the ones more focusing on a particular area like credits, for instance. But in your scope, I would say, which are the strategies you are really very favorable on, and what are the return expectations you have?
So it's very interesting questions, but it's clearly depending of what you are looking at. Clearly, I won't say there is one topic for 2012. I say you've got in the hedge fund space what I call must-have strategies. So strategies you must have within a portfolio, whatever the environment is. Because such strategies are adding diversification, are helping you to mitigate risk, to manage fat tails events, such as in 2012. And such example of such strategies are, for me, CTAs, so fund of futures, or some global macro strategies with a short to mid-term horizon and a strong risk management policy. And this morning during a panel, we were looking at global trends and opportunities to capture global trends. So the good news is if you invest in a CTA, they are designed to capture these trends, whatever the environment is. So the first answer to your question in terms of strategy picks for 2012 and for the years to come, for me, are some strategies have to be structurally in a portfolios. And one example is CTA. That's my first answer. My second one is relative to if you are looking to diversify your bonds portfolio. So clearly that's a topic for many investors today because of level of interest rates first, and also because they are not always perceived as risk-free assets. And I think here you've got many leverage strategies in the hedge fund universe, mainly within market neutral approach, whatever it is on equities, on credit, on commodities, which are targeting returns around LIBOR plus 3, LIBOR plus 5%. And there are, in the current environment with very low bond yields, real attractive strategies to add within the portfolios. So that's for the second answer. And my third answer will be more related to current environment. Clearly today I'm bullish on two main strategies, more a tactical bet, I would say. The first one is on M&A. I think the credit environment is positive, and I'm sure we'll elaborate more on that later on. And many companies have strong balance sheet and low organic growth, and looking for other source of growth. So the M&A market is a cyclical market. We are picking up, and I think this cyclicality will be positive for the months to come. And the last strategy I will favor in 2012 is currency strategies. I strongly believe, but the timing is very difficult to predict, that at the end of the day, currency will be the best mean to balance the global imbalances worldwide. So the debt issue, the account issue of different countries, the balance account issues, will be solved by movement in currency, and currency strategies are offering good picks to play that game.
You forgot convertibles and distressed as well.
Yeah. But I'm sure you're going to talk about it.
Yeah. Well, obviously, I'm biased. You know, the way that we approach our strategy, so everything from convertible arbitrage to credit long short and investing in some distressed securities, we really focus on companies that, you know, are high quality companies. One of the biggest themes in our portfolio right now is companies where we know that they're going to be able to pay their debt off. So in other words, if the worst case scenario is if we have to hold their bonds till maturity, we know that, you know, they have some cash or a credit line or something that will pay their debt off. That's really been a big theme of ours. And the way that we approach our strategy is it doesn't matter, if we're doing our job right, it shouldn't matter where you are in a cycle. In other words, we approach our strategy by doing a lot of credit research, bottoms-up research. And if we're doing our job right, we're going to be picking which credits to go long, which ones to go short. And the one thing that we've done historically very well at is we've avoided, you know, the majority of the, you know, blow-ups or bad credits, et cetera. I mean, we're not perfect by far. We definitely have our own self-inflicting wounds. But, you know, we did a very good job in 2008. You know, we were actually positive in 2008. In 2007 as well, and then coming into more recent as well. And we've really focused on idiosyncratic credits. It's the one-off single situation credits. More recently, our portfolio on the long side, which is a good quality portfolio, we've been focusing on shorter term maturities where you know, there's bonds trading at a discount from convertible bonds as well as high yield bonds. We've been focusing on a lot of event-driven situations, anything from different, you know, lawsuits to all the way to different liquidations that are going on from the distress perspective. And then on top of that, you know, we're actually short quite a bit also. We're not comfortable kind of sticking our necks out at this point where, you know, we're still, even though the markets have pushed Europe off to the side, you know, we're still concerned that, you know, Europe is still a risk. And, you know, we're still short quite a bit. Now, the majority of our shorts, we have a lot of single name shorts. A lot of them are the lower quality type of companies that have ramped up, you know, as the markets go up. And then, you know, years like 2011 really forces you to become more of a macro type of trader where you have to kind of hedge out your portfolio from a macro perspective as well. So we've been running our shorts where, you know, our net exposure has been tight and we've been trading it around as well. So from a strategy perspective, we're seeing a lot of opportunity. Our convert portfolio is about 5% cheap, and that really will depend on what you own. I mean, we have converts that are 2% cheap, and then we have converts that are 9% cheap to fair value. The technicals have remained strong. New issuance hasn't been great because the high yield market has been trumping the convertible market, but if rates start rising, I would expect the new issue market in the convertible market to increase. And then, you know, on the distress side of things, as I mentioned earlier, we're going to be launching a liquid distress fund, you know, focusing on, you know, some of the bigger quality type of names, once again, staying away from the smaller issues, low quality type of names. And depending on where the distress cycle is we're going to be looking to make money in different fashions. The way that we approach the strategy is, you know, your typical distress fund generally, you know, is long biased. You know, they will sit on cash if necessary. They become restricted. They don't use leverage, things of that nature. We approach it where we do use a modest amount of leverage, you know, something within around 1.5 to 2 times levered the most, mostly on the short side of things. You know, we don't look to get restricted, and if we do, it's on a one-off situation. And we're always going to remain vested. So in a market like today, where we have a more balanced approach versus like coming out of 08 into a 09 type of market, you know, you're definitely more long biased. I don't want to take up too much of your time.
That's okay.
Because I know you're going to talk about converts also, right?
Yeah, I might do. As Michelle pointed out, we still live in an uncertain world, and volatility, you know, has continued even today, even after that brief market rally. So I think as a fund of funds manager, we have to think about the global picture. We need to consider the macro environment. But at the same time, we think that the volatility itself has created lots of individual opportunities. So don't want to ignore some of the more fundamental offerings that are out there. So I mean, there is uncertainty about whether the economies of the West are going to slow down or accelerate slowly, or whether there might be double-dip recessions here and there. Will China have a hard landing? Are the emerging markets going to couple or decouple with the developed markets? Is there going to be a resolution in Europe? All of that has created pricing opportunities. So overall, what we're trying to do is be diversified, not be concentrated in any one particular area. Focus on the fundamentals and be macro aware, and look for managers that are macro aware as well. So three of the kind of areas that we're looking at would be nearer term event driven credit and equity opportunities. So looking for managers who are looking for events, and it may be mergers and arbitrage, maybe merger arbitrage, it may be other types of corporate event, but very much in the corporate sphere, investing across the capital structure, looking for specific opportunities, special situations, for example, post-reorganization, equity and credit. Liquidating estates is another area where we've seen opportunity recently and think there will be more going forward. Another opportunity set we're looking at is more of the macro-aware type trades, so nimble tactical managers with a trading type orientation, some global managers, some global macro type managers, and managers that are looking for asymmetric payoffs within a more globally structured book, perhaps working in currencies and interest rates, that kind of thing. So more global macro type trades, but also trying also, because we have a bias towards fundamental approaches, to keep that very specific rather than big type global macro, if you know what I mean. And then the third area that we think there are opportunities in are relative value trades, again, that have been generated through this global dislocation and mispricing of securities that you've seen through the volatility that the markets have experienced in 2011. And so these are very much hedge positions. Emerging market equity is an area that we're looking at with a fundamental bias, but being hedged. And we're also looking at other less efficient global markets, for instance, the Asia region, where we see many opportunities and where trades are very much uncrowded and where smaller, more nimble managers can do well.
Peter?
I guess it's always difficult to discuss sort of which strategies are going to do well in sound bites, because inevitably there are big questions around the volatility budget of investors and the extent to which investors are seeking non or negative correlation. And certainly amongst our strategies, we have different strategies which are positioned to do very different things within those buckets. And in simple terms, you will often be trading correlation for returns. Within that context, I think there are two themes which particularly inform how we're investing at the moment. And so, and to digress for 1 second, my role at CQS is I'm responsible for allocating assets within some diversified mandates between the various strategies that we think about. So I've relatively developed thinking in terms of our strategies, but perhaps less so more broadly. I think there are a couple of themes which are important to us. And firstly, unfortunately, I was in some meetings this morning. I didn't attend most of the morning sessions. Looking at the speakers, I would be surprised if they were all full of wild long-term enthusiasm for risky assets. There's something we always talk about at CQS, which is the last risk is the risk of not being invested and of not doing stuff. And actually, right now and in the first few months of this year, we had quite a strong view that LTRO, quantitative easing, various other factors would be supportive of risky assets. So we came into the year in a number of our mandates looking for ways to get long the market, but in a risk-controlled, asymmetric way. And in particular, we're running quite a lot of exposure to short-dated corporate credit. And in particular, we're looking at situations where we have a high degree of confidence in the individual balance sheet and where through various structured trades, we can source at quite wide spreads what we think are very good credits on a 6, 12, 18-month basis. And that type of long can be selectively volatile on occasion, but also those unrealized losses will come back to you pretty quickly. So we find a lot of value, especially in short-dated credit. And by short-dated, obviously, we can also manage our duration to be pretty much zero, and we're very happy to do that as well. And that will run right the way across asset-backed securities, converts, investment-grade high-yield credit. Not particularly loans at the moment. We think the loan market, you're going to get better opportunities sometime later this year rather than now. And the second theme that overlays that and goes a little bit, I think, to the last comments, we do think that the structural shifts underway in markets, in particular regulatory shifts, are creating some secular changes in how markets operate. And in particular, what I call Basel 2.5, so the changes implemented at the back end of 2011, prospective Basel 3, Solvency 2, Volcker rule, all these things are removing risk capital allocated both to providing liquidity in markets and also to proprietary trading by the investment banks. That's creating opportunity for hedge funds, opportunity in a lot of those areas where traditionally the proprietary banks were very active, also opportunity in markets which are more volatile. And I could talk at great length about the theme, but in the simplest terms, corporate bond markets are kind of getting bigger because banks are lending less, because the European CLO markets are not being refreshed and for various other reasons. So corporate bond markets are getting bigger at the same time that banks are withdrawing risk capital from providing liquidity. And in our view, that is exacerbating volatility. How do you play that? You find ways to get long that volatility. As an example, the CDS market, another way to describe a credit default swap, it's a put on credit, and it's a way of getting long volatility. So there are lots of different ways of doing it, but we're looking to build in protection into our portfolios and asymmetry, in particular through using those type of volatility-sensitive strategies.
Thank you, Peter. I'm very happy that you're talking about regulation and the impact of it on hedge funds, and I would like to invite the other members of the panel, if they have a view on that, to expand on it as well. Does anyone would like to comment on the impact of regulation?
Well, definitely from the bank perspective, with all the proprietary desks and so forth, it definitely took out some of the volume in the markets, especially in the credit markets as a whole. So, the impact, well, that also creates opportunity, we should say. From being a hedge fund perspective, it's been more from a paper perspective than anything, especially if you're already registered. Other than that, there's definitely, specific situations between banks and Basel III coming and things of that nature that, a lot of the, banks have to get capitalized and so forth, that you have to think about some of the regulation impacts as well.
Institutional investors have been unhappy in the past about the so-called unregulated nature of the hedge fund industry. So in a way, the fact that hedge funds are now having to be regulated is possibly a good thing, but it is putting a tremendous compliance weight on hedge funds, and therefore costs have increased. And there's some friction there, I think. The regulation's coming from all directions, though. It's not just hedge funds being regulated. There are new market regulations. There are regulations of the investors as well. Solvency II was mentioned, which may be rolled out to European pension funds as well as European insurance companies, which has real implications for the way in which some of those institutions invest. And then we've got the AIFMD, which we will all have to comply with if we're based in Europe or want to operate in Europe. And that will be an additional burden. But it could also help with firms like us to develop business in some of these areas. So, I think there are two sides to it, and it's an irresistible tide. And I think, our view is that you need to work with sensible regulation, and where you can influence it, as the FSA often gives people the opportunity to do so, you should. But once the rules come in, you have to comply.
Thank you. Before giving the opportunity to the audience to ask some questions, I have one important one for you representing Fund of Hedge Funds in the panel, Fabrice and Stephen. Fund of Hedge Funds have been very much criticized in the recent past about fees, about over diversification, and a lot of other issues. So what is the position you think the Fund of Hedge Funds are taking now, and how are you responding to those elements and to the needs of the clients which are changing?
Okay. I think fund of hedge funds will survive. Clearly, they are attracting less money than before 2008. Before, they were attracting about 2/3 of the money inflows towards hedge funds. Now it's around 1/3. But the model itself is evolving. So clearly, there have been changes. And two main directions for my view. The first one is more and more hedge fund managers are developing customized solutions, so are developing advisory solutions towards their institutional clients and building specific positions, specific portfolios dedicated to their needs. So more and more advice. And the second trend is what is important is not only to select a good fund managers. The key is to build the portfolio. So the techniques, the portfolio construction, the diversification, and the way you're going to put all your good fund managers together. And it will make, at the end of the day, the bulk of the performances. If you select very good managers, but all with the same risk and the same underlying risk, you will have all your buckets in the same basket, all your eggs in the same basket. So at the end, there are some risks. So I think there is a place for fund of hedge funds because it's not only a selection of portfolio managers, which is key when you are investing in hedge funds, but it's a way you are building up your portfolios by adding different managers and by adding different risk profile, and at the end, to build a diversified and a portfolio with going to be more resilient in adverse periods. So fund of hedge funds are challenged about fees. Clearly, there are pressure on fees today, but fees, the market is doing its jobs. If you are not performing, you won't have any assets and you won't gain any fees. So I think the question of fees is not the central question, because here the market is auto-regulating itself. But the real value added for hedge fund managers is the way they are building the portfolio and they are assembling together good fund managers.
Just briefly, because I agree with a lot of what Fabrice has said, and I won't repeat what he has said. Yes, I think that the death of funds has been greatly exaggerated. And I also think that the industry has changed. What funds of funds have been doing for a long time, actually, certainly we and similar funds of funds to us have been working with clients to develop portfolios that fit and work for them. And actually, the idea is that consultants somehow are stepping into funds of funds shoes. Well, what consultants are now doing is exactly what we've been doing. They're offering their own fund of funds. So funds of funds are very much alive if you consider consultant fund of funds as being part of the industry. But that maybe is too controversial a topic to raise at this point in the day. But I do think that our industry will continue. I think some of the smaller funds of funds are very much under threat. There seems to be a perception that managers with less than a certain amount of assets under management are going to be challenged, so you're going to see some of those firms merge or disappear.
And I just giving the 1 second view from the perspective of somebody who gets allocated by these type of entities, I think the last point is really important, that the appetite of institutional investors for advice around creating hedge fund portfolios has not diminished. All that's happened is that the people sitting in the seat of giving that advice are in a slightly more diversified set of places. You mentioned consultants, the big investment banks as well. You look at the big investment bank platforms, and again, they are offering solutions which look remarkably like funds of funds to me. So I think the appetite of investors for allocation advice around hedge funds is very strong. It's just become a more diversified model. So these guys aren't going to be able to work. It's just where they sit may morph over time.
Okay, thank you. I think we have time for a couple of questions from the audience.